Stocks Explained, simply how smart investors think about shares. Most people think stocks are risky. Some think stocks are gambling. Some think stocks are only for experts. All three are wrong. The real problem is not stocks. The real problem is how people approach stocks. Today, I will explain stocks in the simplest possible way so that even if you never buy a share, you will finally understand what is really going on. Let me start with a question. When you buy a house, are you speculating or are you owning an asset? A stock works the same way. A stock is ownership, not a lottery ticket. When you buy one share, you are buying a small piece of a real business with real products, real customers, real profits, and real risks. Now here is the first misunderstanding. People think stock prices move because of daily news. They do not. Stock prices move because of future expectations. Markets ask one question every day. Will this company earn more in the future or less? Everything else is noise. Now let me explain something very important. There are two types of stock participants, investors and traders. An investor asks, is this business strong? Will it survive? Will it grow? A trader asks, will the price move today? Most retail people think they are investors but behave like traders. This confusion causes losses. Now let me explain how institutions look at stocks. They do not chase tips. They do not watch social media, noise. They study cash flow, debt management, industry position, and most importantly, risk. Retail investors usually do the opposite. They look at price first, story second, and risk last. Now let me pause here. If you have ever bought a stock only because it was going up, please listen carefully. A rising price does not mean a good business, and a falling price does not mean a bad business. Price is what you pay. Value is what you get. This single line can save you years of mistakes. Now let us talk about dividends briefly. Dividends are not free money. They are part of your return, paid from company profits. A company that pays dividends is usually stable but not always growing fast. A company that does not pay dividends may be reinvesting for growth. Neither is good or bad by default. It depends on your goal. Now comes the most dangerous myth, that stocks always go up. They do not. Markets move in cycles. There are good years, there are bad years, there are lost decades. Survival matters more than returns. This is why diversification exists, not to increase profit, but to reduce damage. Now let me say something very respectfully. If daily price movement affects your sleep, you are taking too much risk. Stocks should serve your life, not control your emotions. Let me summarize with three clear truths. First, stocks reward patience and discipline. Second, understanding the business matters more than timing. Third, protecting capital matters more than chasing returns. In the coming videos, I will explain how to evaluate stocks simply, common mistakes people make, and how seniors should approach equity investing. If this video helped you, please share and write in comments. Do you invest in stocks or are you afraid of them? I personally read comments. Thank you for your